Today, we have the honor to speak with William White, the famous economist who predicted the great financial crisis a good decade ago, the former deputy governor of Bank of Canada, and expert and advisor at the Bank of England, the former chairman of key economic and monetary committees at the OECD and BIS, the renowned free thinker and critic of many conventional economic thought. Mr. White, welcome and thank you so much for your time.
Well, it's a pleasure to be here. Thank you for the invitation.
Last week, you published a paper entitled, "Suppose the Everything Bubble Bursts. How will the global economy cope?" Are we really in such a serious situation as the title sounds like? And what do you mean by everything bubble?
Well, the phrase, I guess, the everything bubble implies that virtually the price of virtually every asset you can think of has been going up quite sharply in the course of the last little while. And so if you look at corporate spreads, for example, the spreads are very, very low. If you look at the VIX, it has been quite low. Equity prices, particularly in the United States, are quite high. Real estate prices almost everywhere have shot up. The price of fine wine, stamps, it's sort of like back to prior to the great financial contraction, that the price of virtually everything you could think of was going up. And that always tends to make one worry a bit about excesses in the financial system. And then, of course, the question becomes, well, what happens if it all stops? And the answer is that it's probably going to have some pretty negative implications for the economy, because when you look at history, that's what these big credit stroke financial bubbles always wind up doing. After the boom comes the bust. And in the current state of things, of course, that could be quite dangerous to the global economy.
And is it really as serious as the title sounds like?
Well, the honest truth is that I have been worried about booms and busts really since the middle of the 1990s. And that comes out of an earlier preoccupation with what happened in Japan and in the Nordic countries in the early 1990s. But we've had these successive booms and busts, and I guess almost right from the start, back in the middle 1990s, with the Asian crisis, I thought that would be an end on it. But in fact, all that happens is that the money tends to move around, and so you get a boom and bust in one area, and then it reignites someplace else. So in 1995, after the Asian crisis, I can remember thinking to myself, well, it's all over. Well, the Asian boom was all over, but the money just went to Russia and to Latin America. And then the whole thing started all over again. So it may well be that this will just be another localized problem. Prices will go down somewhat, and then the economy will slow down a bit, and then it'll come back. That's entirely possible. But it's also entirely possible that we could wind up with a problem of either serious deflation or serious inflation, in which case the prognosis might not be so good. So it may well be that there's not an imminent problem, but it might well be that we've come to the end of the line.
At the beginning of your presentation, you point out to monetary policy how it created the pre-pandemic economic morbidities. Can you describe them?
Yeah, well, I use the phrase morbidities because, of course, it's now being well used in the context of COVID-19. And the idea is that a patient can, a person can get COVID-19, and generally speaking, it causes problems, but the problems are not all that serious. But sometimes the person that catches it already had something earlier on, diabetes, overly overweight, things of that nature. And in fact, the COVID then just becomes a kind of trigger that actually brings to a head the underlying problem. And that's really the sort of reference to morbidities in the global economy at the moment. And what I really was trying to imply in talking about monetary policy was that the almost exclusive reliance on monetary easing to get the economies to sort of rebound from downturns has got a downside to it. And the downside is that the way that the monetary easing works is that it induces people to bring forward in time spending that they would have done later, but they're induced to do it earlier because the interest rates are low and they can borrow the money in order to do it today as opposed to tomorrow. But the difficulty is that if the money is not being spent productively, i.e. not being invested in something that provides a return that allows you to service the debt, then as time wears on, you just wind up with a bigger and bigger debt. It's almost like a household. You know, you get to the point where you've just pushed your credit line as far as you can push it. And now, instead of spending still more money because the interests are going down, you're totally preoccupied with servicing or paying off the debts that you've already got. And so monetary policy loses its ineffectiveness over time because of the debt problem. And at the same time, while all of this easing is going on, there's a lot of side effects that are building up that people don't think about enough. And my own feeling would be that easy money in the end winds up destabilizing the financial system. It winds up slowing growth as opposed to increasing growth. And you get what I call sort of exit problems, otherwise referred to as the debt trap, where you've got so much debt built up that even if the monetary authority wants to tighten, it becomes so frightened that it's going to spark off another crisis that it doesn't do it, doesn't tighten. But as long as they don't tighten, they're just inducing more people to get into more debt. So the underlying problem is getting worse. So there's a debt trap aspect to this thing. So yeah, I've been saying for quite some period of time that in that regard, we have a problem. We're on a kind of unsustainable path.
Is some kind of a debt jubilee one of the possible ways to get out of this situation?
Well, the idea of a debt jubilee, of course, it goes back to the Bible, and in fact, not even sort of recent stories. I think we're really talking about the origins of this back in Sumeria, which is a long time ago. And the thing about the debt jubilee was that it was the king, basically, and the people around the throne who basically said, there's so much social discontent growing here and the threats of revolution, we'll write off some of the debt and give the people a break. But the point was that the people that were doing the writing off were like really rich and they could afford to do it. So basically nothing changed. The real problem we have today is that all of these debts that have been picked up by so many debts that have been increased by so many people are actually owed to so many other people, including your pension and mine. So that when we talk about debt write-offs, we really are talking about having an impact on ordinary people who invested in the form of their pensions in ways that they thought would sort of give them a good retirement. And the worry at the moment is that the money's been invested badly or non-productively, and that in the end, everybody will wind up bearing the burden. And so, of course, that makes the whole issue of debt restructuring and recognizing that the debts, in fact, cannot be serviced and will not be repaid it makes it tougher and tougher to face up to that, which is another form of debt trap in a sense, because it's saying, I know I have a problem, but to try to resolve that problem is going to be so difficult and so hard, so hurtful to so many people, that there's a great tendency to just, the expression, kick the can down the road, sort of try to find some other quick fix in the hope that when the problem really has to be confronted, that you'll no longer be the person in charge. Somebody else will be the person in charge. So this is sort of classic stuff, really. So debt jubilees be a good idea, but it's not as simple as it seems.
Is it realistic to expect that the big powers would agree upon it?
Well, in the end, I mean, the thing that you have to recognize is that when we start talking about writing off debts, it's the rich people that own them. It's the rich and the powerful people that own them. And in a way, those are the people that have to be convinced that the people who say they can't pay really can't pay. And of course, the creditors, it's just like an answer to your previous question, they also don't want to face up to the reality that the debts that they've got will not be fully repaid. And so there's a tendency to insist that the debtors try to pay. And of course, if everybody gets into the trying to pay mode, then it means it's also the trying not to spend mode. And this is what we call the Keynesian paradox of thrift, that if everybody tries to save, because your saving implies less spending, and spending is somebody else's income out of which they will save. So if you break into that circle, in the end, you wind up, and this is the paradox, everybody tries to save more, and in the end, we all wind up saving less. So that's one of the problems associated with trying to get people to pay when they can't pay. And what would be mutually beneficial is for everybody to agree that the debts must be restructured in a certain way. And so those that have lent the money wind up getting a good proportion of what they've lent back, or at least if they do a kind of debt for equity swap, they get back the promise of gains in the future. And the person, of course, that has written off the debt also benefits from having the debt being written off. So it can be a win-win situation relative to the alternative. Because the alternative, and this goes back to the days when Bill Rhodes, used to, I think he was at Citibank then, and he was sort of the dean of the bankers. And the basic message, you'd get the bankers around the table. Let's say they all were owed money by Brazil or Argentina or whoever. And basically what Rhodes would say to them was, gentlemen, you have a choice, and it's nothing on the dollar or 50 cents on the dollar, because 100 cents on the dollar is no longer on the table. It can't be done. So reality is your choices are unpleasant. It's either 0 or 50 cents, you choose. So this is the kind of thing that we'll eventually have to get to in some cases.
If you look back in history, is there a particular event that can be characterized as the original sin of going down the bad path in terms of monetary or economic policy, or there are numerous minor events leading to where we are now?
George Soros, I think, would say that, and I think I'd agree with him, that the rot goes back at least to the early 1980s and the Latin American and emerging markets debt crisis. And at that point, many of these countries were essentially insolvent. and the banks that had lent to them were essentially insolvent. Most of the banks being American banks. And what happened was that through some combination of, well, really forbearance, that you sort of pretended that the banks were solvent, and eventually growth returned, and the growth floated the banks off and floated the debtors off. The Japanese tried to do the same kind of thing in the 1990s, and whereas in the American case it worked, in the Japanese case it didn't work. So it may be that the sort of the failure to resolve debt problems really began as far back as then. I would point the finger more directly, I think, to perhaps 1987, which was the first of the major easings in monetary policy in the United States. It was a big stock market crash. I can't remember which month, I think May, but I could be wrong. But the answer was there was a very significant easing of monetary policy in the United States that they never really tightened, perhaps as much as many people think they might have done, until, of course, we had another sort of big debt problem in 1990, not just in the United States with the S&Ls, but also in the Nordic countries, in Japan. And the answer basically was easy money. And then we had the Asian crisis, 95, when one might have said it was time to tighten monetary policy, but they didn't do it. Then LTCM in 97, 98, monetary policy was again eased quite significantly. 2000, we had the TMT equity bubble crash, and the answer was print the money. Then 2007, 2008, the same kind of thing. And yeah, so you get the picture. I mean, it's basically been going on for a very long time period. And in a fundamental way, the point is that if you just looked at your problem today, what people did on each occasion was the right thing to do. But the difficulty was that it was on a path where each time you were stepping one step further down the path and getting deeper into the debt trap that I talked about before that you couldn't get out of. Yeah. So it becomes, in a way, almost a kind of fundamental analytical problem, that if you've got a kind of one period model that says do the right thing today, that's a big mistake, because you're just storing up troubles for yourself in the future. So I think that's basically the fundamental nature of the problem, is that it's been one period thinking as opposed to multi-period thinking.
Having decades of experience from within central banks, can you paint us the way of thinking of the monetary authorities about these things, these developments? I guess there must be some long-term thinking as well, by the analytical structures in the central banks and from various advisors. And it's probably not just from a crisis to crisis thinking that determines monetary policy.
Well, I've been of the view for quite some time that the central bankers, and for that matter, policymakers more generally, have made a profound, what I call, ontological error. It's an error almost in the realm of philosophy. The first question when you've got a systemic problem, the first question you have to ask yourself is, what is the nature of the system that you're dealing with? And I think the framework that is used by most central bankers and by most finance ministries, although perhaps the finance ministries less so, is being that they think about the economy as basically something that's sort of simple and static. And it's something, therefore, that is comprehensible and it's controllable. And the fundamental problem is it isn't simple and static. It's complex and adaptive. It's like an evolutionary, the economic system is like an evolutionary system. It's like your garden. It's just constantly changing. Stuff is coming in, stuff is going out, things live, things die, the system survives or not, as the case may be. Okay? And that's the way we really should be looking at it. And that implies a great deal more humility, that you don't start off by saying, I understand how it works, and so therefore I can come up with a solution that will be a definitive solution for the problem. And that is what we've been trying to do over the course of the last number of years. And I don't think that way of looking at it doesn't have unintended consequences, okay? Whereas what I suggested earlier on was that a lot of what we have been doing, our monetary recourse to monetary easing, does have a lot of unintended consequences that eventually build up to a point where they become a real danger to the survival of the system. But that kind of thinking is not there when your framework is one of a simple model of 4 or 6 equations that basically tries to sum it all up. It's a very different world. And I think that's where we've made the problem. And to say to people, you have to be more humble, you know less, much less than you think you do. It's not, again, it's a bit like saying debt restructuring. It's not a message that people want to hear, particularly when they've been working on the basis of a different model for the previous 50 years.
You have been saying the problem is not business cycles and inflation, but rather financial cycles and credit expansion. Isn't this something that is already so obvious also for the central bank people? Or they are aware of that, and they're aware that they're kind of in the driving seat, but they just don't know how to find the way out?
Well, I would like to think that it was just common sense to say that these were problems, that you could have these cycles of excessive credit expansion, booms, busts, financial asset prices becoming overvalued, other imbalances in the system. But that's not the sort of the prevailing mantra of the central banks. I mean, the central banks are still fixated on price stability, the vast majority of them. So the whole idea is if you've got price stability, everything is fine. Now, having said that, what is sort of interesting is that in the United States, at least, after a long period of time where price stability seemed to be given more importance, that they're now in the process of backing off, so that their concern about inflation is becoming subordinate to their concern with getting maximum employment out of the system. And again, it becomes a kind of more simple-minded, single-focused approach, that if you can sort this problem out in a way, all of the problems will go away. But of course, my way of looking at it is that they won't. And I guess in the context of the United States at the moment, and I think there's a growing concern in the financial markets about this, is that with some combination of massive fiscal stimulus and a continuation of ultra easy monetary policy, which is now being reconfigured in terms of maximum employment and average, the target is average inflation over time, that both of those developments imply a still more expansionary monetary policy than previously, which together with this massive fiscal expansion, which in the end could accumulate to something like 20 or 25% of GDP. We've never seen anything like this. The growing concern is that you will get a return of inflation, which is going to be very bothersome to a lot of people, not least in Europe. So I guess I'm back to saying it isn't a simple view of the world is not sufficient to deal with the various problems that have been building up under the surface over a long period of time.
So the return of higher inflation is probably tightly correlated with the looming problem of the debt deflation that we're in now. What are the possible scenarios of manifesting itself?
Well, one of the things that is inherent, one of the things that's pointed out in the literature about complex adaptive systems, and there is a vast literature on this stuff, okay, outside of economics, because there's a vast number of these complex adaptive systems in both nature and society, is that if the system itself is unstable, it doesn't matter what the trigger is. It's like you can take a balloon and you can put a hole in it anywhere and the balloon will deflate. Okay, the trigger in a fundamental sense doesn't matter. And the literature also says it's almost impossible to predict the way in which a system will unravel. So having said all of that, but basically nobody knows, one concern that the markets seem to have is that inflation, particularly in the States, but perhaps more broadly, commodity prices are going up everywhere, shipping costs are going up everywhere, is that as inflation starts to rise, that interest rates will rise with them. And I think you alluded to it a moment ago. That's the crux of the problem, is that we've got all of those debts out there, and the debts are being rolled over at relatively low interest rates. So it's all hanging together, sort of, precarious, but it's all hanging together. The real worry would be that as the interest rates start to go up, that a lot of people will find that they can't, in fact, pay the debt service. It's become too expensive. And then what you start to run into, and maybe it's in a way it's already begun, going back on Friday, we had this big problem in the stock market in the States, is that asset prices will people will start to sell assets in order to get money to meet their debt requirements, their debt service requirements, or to meet their margin calls, which is what happened on Friday. And then that sets in train a process like we saw on Friday and maybe is going on today. I haven't looked at the screens yet, where people have to sell to get money to meet their obligations, but they're selling and deleveraging just pushes prices down further, which means that they have a bigger problem with respect to margin calls. And so the whole thing goes into reverse. And that's one of the worries that people do have at the moment. But it's only one way in which it could happen. Another way in which it could happen is we're going to, the IMF and others are forecasting very rapid growth for the rest of this year as the vaccines kick in, as the economies open up again. But the underlying problems of debt are still there. So it may well be, and this of course is what the Fed is relying on. They're saying we may have a short run rebound in inflation, but it will only be very short run. The underlying problems are still debt deflation, and that's why the Fed is not going to tighten. Okay, Jerome Powell has been very clear about that. They probably won't tighten rates until 2024. Well, it may well be that he's right, and that that rapid growth will decelerate. The deceleration might actually turn into still slower growth going forward. There's lots of reasons to believe that there's longer term trends that will hold down growth going forward. The demographics are turning very bad virtually everywhere. Climate change, both adaptation and mitigation, is going to be very costly. It's going to drive down growth. Deglobalization, to say nothing of ships caught in the Suez Canal, all of these things could slow growth in time. Well, if that happens, then what you're going to be confronted with is these huge debts, which are already there, but no growth to create the wherewithal to service those debts. And so gradually, so the story I guess one could tell is there may be a narrow path through all of this to sustainable growth over time, but the path is getting narrower and narrower. And you can tell a story about falling off into deflation, too slow growth, and then the debts become a problem because you have no revenue to service the debt. Or you can tell a story about too fast growth and inflationary growth, in which case the interest rates go up and the people with the big debts find they have a different problem. They've got revenues because the economy is still growing, but they have got a still bigger bill in terms of the interest payments on the accumulated debts. So that the path is sort of getting narrower and narrower. Maybe there's still a way out, that we will get through this. And I guess that's what the Fed is sort of betting on or assuming. But it's not hard to tell a story about you could fall off on either side.
You have also noted international financial regulation has also fallen short considerably. In what way? Banking regulation and reporting requirements seem to be greater than ever.
Well, the emphasis really since the beginning of the great financial contraction, in 2008, 2009, the emphasis has been on strengthening the banking system. And in a certain sense, quite right too, because the banks, responsible for payment systems, there's big externalities of the banks if things start to go wrong at the banks. So yeah, so they focused on the banks. But you've got to remember that even the great financial contraction, that it didn't start with the banks, it started with the shadow banks. And there were already all of these sort of off-balance sheet vehicles, these special purpose vehicles and that were associated with the banks. And when the crisis started, these outfits associated with the banks fell in upon the banks to get credit and support. Okay. And then, of course, there was the support from the central banking community, and the regulators went in and tried to make the banks more whole. The difficulty is that the more you regulate the banks, the greater the likelihood that the financing will simply move out of the regulated sector someplace else. And what we've seen since 2009, 2010 has been a massive increase in credit provided by financial markets without the need for a financial intermediary. Bond issues have exploded, particularly bonds of lower quality, triple B minus bonds that are just on the edge of being junk. Massive expansion in that stuff. And within the financial institutions, there's been a massive increase in credit extended by financial institutions that are not banks. But according to the Financial Stability Board, many of these non-banks still have characteristics that are bank-like. That is to say, they may not be banks, but they offer liquid liabilities so that people can come in and ask for their money back. And these institutions like asset management firms or whatever are obligated to give people their money back now. But the assets that they hold are not liquid assets that allow them to do that, because a lot of the assets are illiquid assets. So then what they will do is they will sell the liquid assets in order to meet the requirements of the, and if they sell those assets, then you may get fire sales in those assets, and that just leads to all these other problems. So the whole point is that as banking regulation is strengthened, there has been a movement into unregulated sectors. And I guess my bottom line, although the conventional thinking is certainly not there, and maybe it shouldn't be there, I don't know. But when I look at monetary policy, I say we're on an unsustainable path. And when I look at regulatory policy, I say we're on an unsustainable path, which leads one to think in terms of what might be another path that's more sustainable. And when you think about monetary policy, it's unsustainable because to the extent that it works, it builds up more private sector debt that, if it's unproductive, will eventually mean that the monetary policy doesn't work. So it's on an unsustainable path. And then all of those unintended consequences I spoke about. And with regulatory policy, the way that it works is you've got banks, and banks are subject to runs, and runs are costly. So you have to have safety nets to stop bank runs. But if you've got safety nets, then you've got moral hazard, right? People will be inclined to behave badly. So we say, oh, we can't have that, so we have regulation. So you bring in all the regulations, but regulation just leads to evasion. And then you have shadow banks, right? And then you have runs on the shadow banks. You say, oh, that's costly, so we'll have to have safety nets for the shadow banks. And so it continues forever. It's unsustainable. And it may well be it's sustainable for a long period of time. I simply don't know. Nobody knows. But you can see when you look at the evolution of the process, you can see where it's going to end. And then the question becomes whether you should be thinking about an alternative system that is more sustainable.
Is there a way the monetary and fiscal authorities can prepare themselves for the everything bubble bursting? The international coordination seems to have become increasingly more difficult, but more needed as ever.
Yeah. Well, certainly the G20 process in the last few years has been disappointing, I would say. I mean, it showed tremendous promise in 2008 and 2009. But since then, I think there's been less of a willingness. In part, it was due to the Trump regime and an unwillingness of America to lead. But of course, with the rise of China and the emerging markets, which now make up over 50% of global GDP. So America is unwilling to lead, and the rest of them are unwilling to follow. So we have an issue here. Going forward, one can only hope that there will be a resurgence of cooperation. I'm reminded of something that I'm told Benjamin Franklin, one of the fathers of the American Revolution, once wrote. And he wrote to his fellow revolutionaries, gentlemen, we must all hang together, or we shall all surely hang separately. And what he meant was, of course, that if the British had won the Revolutionary War, they all would have hanged separately.
Yeah.
So it's the realization that we have so many of these global problems that could end very unhappily, that I hope will be the final impetus for everybody to realize that we have to hang together. And so when you think about things like global debt problems, okay, they are global in nature. Pandemics, global in nature. Climate change is global in nature. Okay? All of these things cry out for a cooperative set of policies at the global level. And if you don't get it, then you have monetary policy, independent countries acting independently, leading to currency wars, and you're back to the 1930s again. Regulators that don't get their act together at the global level. So I regulate, you don't, and the business just moves to a different jurisdiction. Climate change, I come in with carbon taxes, you don't, and all the production just moves to you, and we wind up getting as much CO2 as we did before. So you can see how obvious it is that we need this cooperation, and hopefully we'll wind up getting it. But at the moment, it's not been it's not been as satisfactory, I guess, as many people would have liked.
But in a way, kind of a cooperation one could legitimately expect is also cooperation in, the intellectual debate about economic paradigm that we are pursuing, and the obvious situation that part of it would just need to be abandoned or rethought. You are calling for rethinking of the fundamentals of the unsustainable monetary and fiscal policies. In what way exactly?
Well, you get into some very difficult issues here that are essentially multidisciplinary. And I wouldn't profess to have the expertise required to come up with an optimal solution. But what you can do, it seems to me, is you can start ranking things in terms of what are the changes that might be required. Let's just think about the monetary policy, debt, fiscal, that whole range of territory. What are the changes that would be required to make the current monetary fiscal debt situation sustainable? And one of the things that I would suggest, and have done really for over 20 years, is we need what I call a macro financial stability framework, which says that monetary policy does lean against credit bubbles, that's the big problem. It's much more of a problem than, a slight increase in inflation, that you lean against the credit bubbles and you use both monetary and macroprudential regulatory instruments to do so. And that you do this in a much more symmetrical way than we've done in the past. So in the past, both monetary and fiscal policies have always eased much more in the downturn than they have tightened in the upturn. So the upshot has been the interest rates every cycle ratchet downwards and eventually get to zero. And I think I wrote a piece in 2005 that said that's where you're going to wind up. Because that's the way it's going. It's asymmetrical. Fiscal is the same. They never used discretionary fiscal as much as they used discretionary monetary, but the bottom line was the same, that the deficits were always bigger in the downturn than the surpluses were in the upturn. So the debt levels just ratcheted up and up and up, cycle after cycle. And it's obvious, you just look at the numbers. That's the way it's gone. So in this new world of macro financial monetary and fiscal policy, things would be much more symmetrical. You say, okay, well, that'll deal with the problem. Well, maybe it will, maybe it won't. if you wanted to be still more radical, because it's not hard to change policy, right? You need a change in the analytical thinking, but it's just a bunch of people around a table make a decision to do something. So that's not such a hard thing to do. A bit more complicated,
technically speaking.
would be to change people's behavior. And one way that you would do that, instead of relying, for example, on regulation so much, you'd rely on self-interest. So one point would be that if you behaved in an imprudent way running a bank, you personally would be punished for it. And maybe in the limit, you'd go to jail. So in the United States, after the S&L crisis, my understanding is there were 1,000 people who went to prison for what was essentially criminal behavior. Well, this time around, after the great financial contraction, basically nobody went to prison. Well, maybe we need to tighten up on that kind of stuff. Maybe we need more market discipline, so that people in the market would be able to put more pressure on people when they started to behave badly. But of course, then they need to know when people were behaving badly. And what that means is you got to go back and look at the accounting framework, the auditing framework, all of that stuff needs to be looked at more carefully. Then you could think about, I'm getting sort of still more, more difficult as you go down the road. You could change the structure. Okay, there's nothing sacred about structures. So for example, you don't like the implications of globalization in the financial system. Well, let's roll it back, and we'll roll it back in the sense of there'll be no more branches. There'll be separately capitalized subs in each country. They'll still all belong to Morgan Stanley, but they will be separately capitalized, and the national regulatory authorities will know where the capital is. Right? You could think about that. Another big problem, of course, is consolidation, too big to fail. Break them up. You can think about that. Securitization, where people are basically borrowing money on the presumed value of collateral. Well, collateral can lose its value, as we know. Just think about what happened on Friday, where you start calling for margin because the collateral isn't there anymore. So what you say is we'll start making loans now on the basis of anticipated revenues. But that's going to be hard. So you can think about a whole list of things, right? Sort of where it gets more and more of a deviation from the normal. Another approach, a lot of people have suggested this, is you just have much higher capital requirements. So you forget about all of this macroprudential and, whatever, where stuff changes over the cycle, where you try to lean against the cycle. No, we're just going to make the financial system impregnable. Okay, so we're going to have capital requirements that are going to be very, very high. We bring in other kind of measures that you could think of to prevent systemic failures arising from financial problems in one part of the system. But you're getting further and further away from an easy solution. Well, maybe in the end, and there are people out there, have been since the 1930s, recommending much more radical solutions. One of them is narrow money, which basically says banks can no longer create money, which is what they can do in a fiat money system with less than 100% reserve requirements. Banks have got leverage. Effectively, they're creating money as they go. Stop it. Just basically say that all deposits have to be backed up 100% with government bonds or deposits at the central bank or something of that nature. In which case, you break the link between debt and money. You prevent the financial system from engaging in leverage. The government winds up getting all the seigniorage from people who actually want to hold money, something that they can use to buy stuff now. And anybody that wants to invest in the future, knowing that it's risky, They will have to accept the fact that their investments will be at risk. And this was suggested, this was the so-called Chicago School in the 1930s. And these proposals were supported by some of the most outstanding economists in the United States at the time. But in the end went nowhere. But when you think about all of this stuff about central bank digital cash, it's not hard to tell a story about how that sort of leads you into this kind of thinking, because then the central bank issues all the money. And then the question becomes, what happens to the commercial banks? Well, the answer is they no longer issue money. They basically manage money that's at risk. So that nobody's got a backstop other than the backstop that's provided by real money, which is always there and it can be spent. Everything else is at risk. So that's when you start talking about more radical solutions, there's a whole list of things, from things that are easy to do politically, we want to put it that way, to things that become more and more difficult.
Yeah, it was just, at the back of my mind about these radical solutions that you just listed, where to get the political will to do them?
Well, it's very hard to know. I mean, I can remember, I've been going in and out of the OECD now for over 40 years. And I can remember this debate 40 years ago. Is it easier to make big changes in good times? Because then you can buy out the people that need to be bought out. The people, the vested interests that don't want to change. You can bribe them. You can pay them off. Or is it easier to do in bad times, when basically everybody recognizes that the system is broken and it needs to be fixed? And I think, sadly, the evidence seems to indicate that it's more likely that you get big change when everybody realizes that the old system is broken. And what that means is that we'll have to go down this unsustainable path until it is unsustainable, or until it is no longer sustained. And then you'll get a big crisis and change will happen. It's a bit like, everybody realized at the end of the 1930s that the underlying problems were in some fundamental sense economic, and that we'd gotten into a set of circumstances with the gold standard that really meant the system had to change. And, the war was still going on, right? When Keynes and Harry Dexter White and all those people were just spending hours and hours thinking about how the system could be reformed. And that led up to Bretton Woods and led up to everything that came afterwards. So it was the recognition of there's a crisis and the origins of the crisis, that recognition that ultimately led to change. So let's hope it doesn't have to get to that point.
Yeah. Monetary and fiscal policies seem to be merging ever more tightly. What is your opinion about that? Why does moral hazard seem to be at the far back of everybody's mind? And are we talking mainly about elected politicians avoiding unpopular measures and leaving them to central banks to implement?
Well, I think really going back a long way, we needed some more fundamental changes to get us off this unsustainable path, fiscal and monetary. Over the course of the last couple of decades at least, it has become fashionable to use monetary policy with a lot of vigor in the downturns, thinking that it can solve all of our problems. And of course, the fiscal authorities, the governments, the politicians really want to believe that monetary policy can sort out all of the problems, because then they don't have to do like really hard things, politically hard things, like restructuring and all that kind of stuff, dealing with the debt problems, having to run bigger surpluses in good times. You know, nobody's saying they should run smaller deficits in bad times. They should definitely run. The problems mostly emerge in the good times when you're not doing the prudential things that you should be doing. You know, so there's a great willingness to believe that monetary policy can sort this out, and that's basically why they've relied on it so much. And now what's sort of interesting but also dangerous is that the monetary authorities and so many others are basically saying, look, we've come to the end of the line. And so the ease with which the fiscal authorities have moved from austerity to, well, of course, fiscal policy has got a role to play in the pandemic. Oh, and by the way, we probably shouldn't have had so much austerity back in, you know, during the global financial crisis either. Okay, so fiscal is where it's at. So now we've got this combination of easy fiscal and easy monetary. And for the moment, at least, everybody finds that quite satisfactory, you know, because it's easy to spend money and it's easy to keep the interest rates low. But the difficulty is, what does all this mean for tomorrow? And it goes back to what we were talking about earlier on, that maybe the end game here will be inflation or still higher debts on the part of the government. And of course, we know from history that if the government debts get too high for them to service in a reasonable way, then they just move into the central bank to do the financing for them, which is not a million miles away from what we have been doing, right? Not in a planned way, not in a coordinated way, but ex post, that's what's happened. You know, the government debts have gone way up and the size of the central banking balance sheet has gone way up. And nothing really bad has happened in consequence. And so there's a great tendency to say, well, we did this in the past and it hasn't done any great harm. And we have a new problem today. So why don't we just do that again? Because we did it before and it didn't do any harm. But it is doing harm underneath the surface. And the worry, of course, is that if you do too much of it, that you'll eventually wind up with a big problem. So, so there's a lot of human nature in this. Eh? I mean, it's not like we're seeing this first time ever. I mean, if you go back to all the sort of the debt crises in Latin America, you know, there's a very strong flavor of the banks, you know, bad debts, the banks get in trouble, the government bails them out, then the government needs bailing out, the central banks come to the rescue. And as the phrase goes, the rest, as they say, is history.
Yeah. What should governments be doing right now, and they are not?
Well, I think the real question at the moment is recognizing that we've got a lot of problems building up together. I wrote an article a little while ago, which was called, it was published in an American journal called The International Economy. And the article was called The Four Horsemen of the Apocalypse. And you know, in the Bible, they speak about the four horsemen of famine, war, pestilence, and the last one, death by beasts, which of course 3,000 years ago was watch out for the wildlife. But you think about the modern analogy is famine is we've got big economic problems, the debt problems, all the stuff we've just been talking about. War is all of the political problems. You see it in so many countries. I mean, in Europe, thinking particularly about Poland, Hungary, but also France, you know, Germany, where you've got this strong populist and certainly anti-centrist stand. The United States, many, many countries, we've got big political problems in terms of division and the question of which of the alternative extreme groups are going to come to the fore. We have political problems, short of war, but we have political problems. The pandemic, of course, speaks for itself. And the last one is death by beasts. And the modern analogy is the environment fights back. We've got big problems in terms of climate change, acidification, the list the list goes on. And all of these problems are big problems, and they all have to be faced at the same time. And I think what the governments have got to do, the first thing they've got to understand is the magnitude of the challenge that they face and the necessity to think of some relatively, by recent standards, extreme responses to extreme problems. And, things like carbon taxes and getting rid of fossil fuel subsidies and dealing with the debt problem, the overhang of debt, international cooperation on the pandemic side. I mean, this vaccine business and, cutting vaccine exports when I'm making this up, but, let me make it up and say that there's 25 components to any particular vaccine, and they come from 25 different countries, and there are 25 different countries for each vaccine. You know what I mean? We're so much in this together that, if even that starts to unravel, then I think we're in pretty tough shape. So the first thing I think we all have to understand is that we have some big problems. They're in large part global problems, and we've got to start thinking about some serious measures to try to contain them. Or we should all surely hang separately.
What should central banks be doing right now and they're not?
Well, the central banking thing is very difficult, and I've sort of wrestled with this. I mean, in principle, what you would say is, well, monetary policy has been too easy for too long, so therefore you should reverse it. Well, it's not as simple as that, because you always have to live with the side effects of what you've done. So we have this debt fragility problem that I spoke about before. So in some longer run sense, monetary policy ought to be normalized, but it's going to have to be done in a very careful way, and presumably in the context of other measures that will deal in an orderly way with the debt overhang problem. Because if you don't deal with it in an orderly way, it just means that the damage that can get done as monetary policy starts to tighten, because there's so much debt out there that's unresolved that everybody knows is bad debt, that you start to get a rush for the exits. So monetary policy has to tighten, but it has to tighten in a very careful way. And I guess my sense of it would be that it ought to be done in really at the same time as you get this debt restructuring. That also is difficult, because the minute you start talking about debt restructuring, it's almost the same thing as saying we're going to tighten monetary policy. The danger is always that everybody is exposed. That's for the exits.
What is your opinion about the recent push for CBDCs, the central bank digital currencies? Is this really going to help, or are we talking just another way of papering the damage caused by epistemological shortcomings? Can CBDCs actually mean death for commercial banking and just another manifestation of thinking the economy is controllable?
Well, it is closely related. And I'll be honest with you, I have not spent as much time thinking about this range of territory as I should have done. But clearly, when you start talking about central bank digital currency, one of the big worries that I hear central bankers talk about is that you've got commercial banks, and commercial banks still offer money or something that looks like money. But it isn't, because the only real money is central banking money. And it's only the promise to provide notes, by the central bank in exchange for M1, current accounts, that makes current accounts equivalent to money. Okay, it's a promise on the part of the central bank. Well, if you get a world in which the central bank starts offering all of this stuff itself to ordinary people, whenever there was any kind of a problem in the system, people would basically say, well, I know my money with the commercial bank looks like money today, but it might not be money tomorrow. But my money in the central bank is always money. And so you get these big withdrawals out of the commercial banks into the central bank. And that could create all sorts of disruption. Well, in a certain sense, the answer is obvious, that you stop the commercial banks from issuing deposits of that nature, that promise to be money when they aren't. But that's back to narrow money that we were talking about before, which is really a quite radical change in the system. So I haven't thought this through, to be honest, but it does seem to me that there is a link there between these two proposals. And I think the central banks are starting to think about that in the context of a broader think. We were talking earlier on about sort of non-regulated shadow banks, all that range of territory, where one of the underlying problems is that these outfits pretend to offer deposits that are liquid, i.e. they're money. You can have it back at 100 cents on the dollar today. The real worry that sort of people are becoming increasingly aware of is that's not true. It's like Mark Carney said a while back about many of the mutual funds and the asset management companies. And I think what he said was, they are built upon a lie. He said that they say you can have your money back 100 cents on the dollar, all of it, and you can't, because they don't have the assets, the structure on the asset side of the balance sheet to allow that to happen. It's built upon a lie. So as soon as you start thinking in those terms, you have to start thinking about what is money really. And of course, there's a number of people that are doing precisely that. So it may well be that there's some more fundamental thinking that is required. Maybe it's actually going on, and that maybe something will come of it. On the other hand, maybe nothing will come of it. I don't know.
To what extent has the trust in the present fiat money system eroded already?
Well, that is hard to tell. There is a suggestion, of course, that the rise of Bitcoin and these cryptocurrencies is a reflection of an underlying mistrust in fiat money, and that eventually you'll need something else, gold, something real, cryptocurrency, that this has emerged because of an underlying distrust. I don't know. I guess I would have thought that if that was the motivating factor behind it, that you would see the interest in cryptocurrencies rise and fall with concerns about inflation. But you don't see anything like that. It seems to have a life of its own. And it seems, in fact, that it's more linked in with the credit cycle than anything else, that when monetary conditions are very easy, that the price of everything goes up, the everything bubble, including crypto. So I don't follow Bitcoin at all carefully, but I understand the last little while it's been going up very sharply. And it's all part of everything else.
You have been working for the BIS. How different is the work there? Are non-conventional monetary policy ideas taken into serious consideration to any greater extent compared to national central banks?
Yeah, well, I think no, I started at the BIS in 1994 and I left in 2008. Although I'm still in contact with some of my ex colleagues, but the BIS has always had a bit of a different view. And if you go back to the work, for example, of Alexander Lamfalussy, who was there in the 1980s, this is where all of this stuff about macroprudential really started. The idea that you have to think in terms of the system, that implicitly it's a complex adaptive system. Lamfalussy never used those words, but if you go back and you look at the stuff that he wrote back in the 1980s, it's all very similar. I did a book review of a bunch of his essays that was put together by the National Bank of Hungary and the National Bank of Belgium. I did a book review for, I think, the European Journal of History, Economic History. And this way of thinking about the system and about credit as a threat to the system and debt overhangs and all that stuff, it's been around for a long period of time. And indeed, macroprudential. There was an article written by the bank archivist in the BIS Quarterly about the origins of the word macroprudential. And it goes back to the Cook Committee, the original bank supervisors that preceded the Basel Committee. So it's been around at the BIS for a long time, this way of thinking. But I don't, the problem is it hasn't got the kind of traction with the central banks that the BIS staff would have liked, that they are still mostly preoccupied with inflation control, or now in the United States with maximizing employment. Whereas I guess the BIS view has been fundamental problem is the credit cycle and booms and busts, and it results in a lot of problems, and they seem to be, as you've deregulated the financial system starting in the 1970s, these problems have become worse and worse. Crises are getting bigger and bigger. They're happening more frequently. But it's not an idea that's really caught on all that much. So it was pretty, when I was the chief economist at the BIS, it was pretty frustrating. But the thing you have to understand is that many of these institutions have got hundreds, if not thousands, of PhDs who are wedded to the analytical framework that they learned in university. And it just happens to be a different analytical framework from the one that I would espouse. But there you have it.
Are we looking too little back into the history? And why are we inclined to always say, oh, this time is different?
Yeah, well, I think that title, of Ken Rogoff and Carmen Reinhardt's book, This Time is Different, in a sense, just says it all. It's human nature to want to believe that when the good times are rolling, that they will roll forever. I mean, even Irving Fisher in the 1930s, in the late 1920s, said that stock prices were at a permanently high plateau. And then he lost his own personal fortune almost entirely, when the stock market crashed. So there's a tendency in human nature to want to believe that the good times will last forever. And unfortunately, they don't. And as it says in the Bible, remember the story about the 7 fat years and the 7 lean years?
Yeah.
They knew 3,000 years ago. Just because times are good doesn't mean that they'll stay good.
Yeah.
So that's what we need. We need a system that is more forward-looking, that, as I said, more symmetrical, that it's the same thing as the 7 lean years, the message that was given to Pharaoh then was, during the 7 fat years, build the silos, fill them with wheat, because you'll need them. And that's what we should be doing during the good times, is preparing ourselves for the bad times.
Looking into the future, what kind of international monetary system do you envision? Can the dollar maintain its role as the world's base currency?
It will maintain its role until somebody proposes a viable alternative, or until a viable alternative emerges. But when you look at Europe, it's with the problems of, unanimity, and it's hard to believe that they can do that. Although I must say that the recent steps that they took to, issue 750 billion euros out of Brussels, as opposed to the national capitals, is a big step in that direction. China, of course, could be an alternative or a complementary currency, but again, got to ease up a lot on capital controls and all that stuff. That's not easy to do, given the character of their system. So then you're back to saying, can you get some kind of international reform to replace the dollar? That's not going to happen unless there's another big crisis. So I think, the dollar will be with us for quite some period of time, but it creates problems. I mean, you think about emerging markets in particular. I'm not sure what the numbers are now, but last number I looked at was there was something like $12 trillion worth of liabilities issued by people who did not earn dollars. Their revenues were not in dollars, so they had a currency exposure. So this kind of stuff will increasingly emerge as problems. The last time around in 2009, 2010, you may remember that the European banks had a huge problem of finding dollars to fund their longer-term dollar assets in the US. They were net long US dollars, but gross, they had a big problem. They lent long and they borrowed short. And so the Fed stepped in with all those swap facilities. And this time they've done the same thing again to a limited number of emerging market countries. Question is, will it be adequate? A lot of the countries that are going to have trouble are not people that are part of the current swap lines. So there's just an indeterminacy out there that's a bit sort of worrisome. And the US, of course, the dollar may be the central currency, but as John Connolly said back in the 1960s, it's our dollar, but it's your problem. And there's a lot of truth in that, because the Fed and the US government, I mean, their first responsibility is to the American people. And, that's legislation. I mean, it's not like it's willful thinking on their part. The first responsibility of any government is to its own people. Well, that's what they have to do. But they're still in control of the dollar, which is used by everybody. So in some fundamental sense, we have a system that's got nobody in charge of it. And it's all very well to say, trust the market system, it'll work it all out. I don't think it will. And you see it with all these currency mismatch problems, and, problems emerge in this kind of a complex adaptive system. So this thing will be spoken about at some point, but precisely when is anybody's guess.
Mr. White, thanks so much for your valuable time and this great talk. Hope we can do this again sometime in the future. In the meantime, where can our audience continue to follow you?
Well, they can go to my website. It's williamwhite.ca. So okay. Virtually everything I do goes up on the website, for better or for worse.
Great. I wish you have a great day, and hope to speak to you soon again.
So thank you very much.